Welcome to the eighth episode of Dividend Investing Insights, your one stop for all things dividend investing. Join us as we explore the world of dividend investing. In the episode today, we will look at dividend aristocrats, and you'll be amazed as to how wonderful companies exist that have the ability to not only give a dividend in the current year but increase the dividend in the years to come. Let's start with the episode. And like always, before starting the episode, let us look at the performance of the markets. S&P 500 went up 3.38% in the last 1 week. Nasdaq 2 went up at 5.04%. And here locally, ASX 200 went up 1.08% to finish at 8,099 points. As I've said before, as a dividend investor, you should not be bothered by the stock prices going up or down, as the stock prices go up or down all the time. And you, as an investor, should be focused on stocks that are able to consistently pay dividend now and in the years to come. Let's get deeper into dividend aristocrats. Dividend aristocrats are companies that have increased their dividends in each of the 25 consecutive years. This itself is amazing. So they have been consistently paying dividend for the last 25 years, and not only paying dividends, but also increasing their dividend each year. So, as an investor, you can predict a stable income, and not only a stable income, but an income that is increasing with every year. This itself, so in fact, S&P 500 also has a fund which is called as Dividend Aristocrats, which was launched in May 2005. It started with 52 companies. As of this recording, it has 67 companies, and as companies increase their dividend or decrease their dividend or are unable to pay the dividends, companies move in and out of this list. And currently, it has 67 companies. The most recent exit that has happened from this company is because of 3M. 3M could not pay its dividend in the recent year, which is why it went out. Anyway, uh, some of the dividend aristocrats, some of the large corporations of the world: Coca-Cola, McDonald's, Aflac, which is an insurance company, Caterpillar, building equipment manufacturer, Walmart, big retailer, Stanley Black and Decker, Chevron, which works in oil and gas, Johnson and Johnson, a pharmaceutical company, Colgate Palmolive, FMCG. So you can see there are companies of all kinds which form part of the dividend aristocrats. The common factor being that all of them have been paying dividend for the last 25 years, and not only paying dividend for the last 25 years, increasing their dividend with each year. Let us now look at some of the data for these companies, and we'll look at a few companies, look at the market price, look at the dividend yield, look at the payout ratio, look at the PE ratio and PB ratio, and you'll be able to gather as to how the data looks like, the stability you'll be able to see. And for our comparison, for our observation, we will look at Avlac, Chevron, Coca-Cola, McDonald's, Johnson Johnson, and Walmart. This is just a select list, and you can look at more companies, you can look at similar data to get an indication as to how these companies are performing. Let's look at Aflac first. Aflac has a market price of $108.59. It has a relatively low dividend yield of 1.84%, but a very good payout ratio of 19.39%, which indicates that it has the ability to increase a dividend significantly if it wants to. However, it has a dividend yield of 1.84 at the current market price and a payout ratio of 19.39%. PE ratio also is not very high at 11.44, and a very good PB ratio of 2.33. So for an investor, except the dividend yield, this stock is very good. However, if you had bought Aflac a few years ago, you can pretty well be assured that your dividend yield would be higher of 4 or 5%, if not more. Okay, anyway, let's look at Chevron now. Chevron, as of this recording, has a market price of $140.61, has a dividend yield of 4.64, a payout ratio of 62.18%, a higher PE ratio of 13.92, and a PB ratio of 1.6. Um, Dividend yield better than Aflac. However, the price is not extremely high looking at the PE ratio and the PB ratio. There's not too much of premium, but that's an indication. Let's look at Coca-Cola. Coca-Cola, as of this recording, has a market price of $71.41, a dividend yield of 2.72, payout ratio higher than what it ideally should be, between 30 to 70%. It has 76.83%, but still not not very high. It is higher than what it should be. P ratio is quite high at 29.03 and a PB ratio of 11.9. However, as an investor myself who have been following Coca-Cola for a very long time, um, if the investment was made a few years ago, the numbers would have looked very different. The dividend yield would have been upwards of 7 or 8%. The P ratio and PB ratio also would have been quite less. Let's look at McDonald's now. McDonald's, as of this recording, has a market price of $296.53, a dividend yield of 2.25%, a payout ratio of 57.8%, P ratio is high at 25.97, and a negative PB ratio. What does a negative PB ratio mean? A negative PEB ratio indicates that the liabilities are higher than the net assets. Um, Although not the best scenario, however, this could be a business move that McDonald's has made, which eventually gets to a positive PB ratio and business doing better. However, for a dividend investor, if you are going for a new buy in McDonald's, it may not be a good idea to buy a stock with a negative PB ratio. Let's look at Johnson and Johnson. Johnson and Johnson is another big dividend investor, dividend payouts stock. As of this recording, has a market price of 165.52, has a dividend yield of 3%, a payout ratio of 72%. Again, a little bit higher than 70%, but not very far off. PE ratio is quite high at 25.08 and a PB ratio of 5.57. Lastly, let's look at Walmart. Walmart, as of now, has a market price of $80.6, a dividend yield of 1.03%, a payout ratio, a very healthy payout ratio of 41.41%, a PE ratio, a very high PE ratio of 41.98, and a PB ratio which is not ideal but still high, 7.67. So what you will see if you put all of this selective data together. Again, I have picked these stocks at random, without any preference. Although Coca-Cola is one of my favorite stocks, but still, if you look at it, the PE ratio and PB ratio is lesser than the technology stocks that we had looked at a few weeks ago. Payout ratio is all of them are in a healthy range. Dividend yield is between 1 and 4%, with an exception of Chevron. But so typically, and market price is a reflection of many things, so let's not talk about the market price. But a common theme that you will see is the dividend yield is typically between 1 and 4%, payout ratio in most cases between 30 and 70%, and a PE ratio and PB ratio of not extremely high, although in some cases we are seeing that PE ratio and PB ratio is high. So this was some of the data. Now, with everything, there are pros and cons. Now, let us look at some of the pros that may exist with the dividend aristocrat stocks. The first and the biggest pro, that they provide a stable income for shareholders. So if you have invested in these stocks a few years ago, you would have got consistently getting your dividend, and not only getting a dividend, getting a higher dividend each year. So it provides a stable income for shareholders. These companies typically have strong financials, which is why they are able to not only pay dividend each year, but consistently increase their dividend year on year. So these companies, dividend aristocrats, typically, companies which are dividend aristocrats are companies that have strong financials. And last but not the least, these are great for long-term investment. Nonetheless, if you want a nest egg for your retirement, if you want a consistent income coming from the stock market, these are the stocks that you can be assured that they will give you a stable income for many years to come, and also the capital gains will grow. With everything, with pros, there are cons as well. So dividend aristocrats by themselves have some cons as well. The only con that is worth noting is that dividends these dividend stocks may produce a lesser capital gain as opposed to some of the other fast moving stocks which are more oriented toward growth investing. So these are not oriented toward growth investing. They are more oriented towards value investing, which is where there is a stable growth, however, lesser in comparison to some of the other stocks like the technology stocks that we looked a few weeks ago. And however, they pay a consistent dividend. Well, that brings us to the end of the episode today. Putting up the checklist again for all those who are watching the episode until now. Use this dividend checklist, subscribe to the channel, and thanks for watching. For more interesting videos and information on dividend investing, look out for our next episode.